Good morning, everyone. Hello and good morning, everyone. My name is Yasser Galfraz, and I'm your tutor for accounting and finance sessions. Today, we will discuss about learning outcomes, know about the context and purpose of finance and accounting. We will start with different branches of accounting, recording financial transactions, presenting financial information, regulatory and legal influences, national regulations, international regulations and conventions, producing balance sheets, producing income statements, producing profit and loss statement. Now let's start with key terminology. What is the purpose of accounting and finance in business? The purpose of accounting is to accumulate and report on financial information about the performance, financial reporting, financial position, cash flow of a business. Then this information is then used to research to decision about how to manage the business or invest it or lend money to. We are going to explore the finance and accounting. You might be wondering what exactly are finance and accounting and why are they so important? Well, let's find out. Finance and accounting are two interconnected disciplines that play a vital role in the business world. Finance deals with managing money, while accounting involves recording, analyzing, and interpreting financial information. So these fields are important for individuals, organizations, and even government to make informed decisions about their finances. Finance and accounting are critical discipline that help individuals and organizations navigate the complex world of finance. They provide reliable financial information, ensure compliance with regulations, aid in planning and budgeting, evaluate investment opportunities, and manage cash flow effectively. By understanding these concepts, we can make better financial decisions and achieve our financial goals. Everybody can see my screen and can you hear me? Okay. Let me explain that different branches of accounting, recording financial transaction, presenting financial information, regulatory and legal influences, producing balance sheets, income statements, and owner's equity statements. So I'll go through the slides, but at the same time, I'll explain in my own words. So we'll learn each of these concepts in a straightforward and easy to understand manner during my lecture. Okay, so what exactly accounting is? Anybody can explain or anybody can tell me? Well, accounting is all about keeping track of the financial transactions of a business. It involves recording, summarizing, analyzing, and reporting these transactions to various parties like oversight agencies, regulators, and tax authorities. Let me show you another slides. Yeah. So, no, I'll carry on with this. In simple term, accounting is like a financial language that help us understanding how a business is doing financially. It allows uh, it allows in simpler term, accounting is like a financial, transaction. It involves recording, summarizing, analyzing, and reporting these transactions to various parties, oversight agencies, regulators, and tax authorities. So in simple term, accounting is like a financial language that help us understand how a business is doing financially. It allows us to track the money coming in and going out of the business and provide valuable information for making decisions. Accounting is a process began with the recording of financial transactions. This means capturing all the money related activities that occur within a business. It could be something as simple as sale of product, a purchase of raw material, or payment of utility bills. Each of these transactions is documented and kept as record. So any question so far? I hope anybody can hear me and can see my screen. If you got any issue, please do let me know. Uh, Accounting is like the language of business, just as we language to communication, business use accounting to communicate their financial transactions. This information is important for various stakeholders such as investors, lenders, managers, and government agencies to understand how a company is performing financially. So accounting is to provide reliable and accurate financial information. Imagine you are working, you are driving car and the fuel gauge isn't working correctly. It would be challenging to make informed decision about when to refuel or how far you can go. Similarly, in business, accurate financial information is essential for stakeholder to make informed decision about investing, lending, or managing the company's resources. Another important impacts of accounting is determining a company's financial position. Just as we check our personal bank balance to know how much money we have, companies use accounting to assess their financial health. Balance sheets are prepared to show the assets, liabilities, and owner's equity of a company. It is like taking a snapshot of company's financial status at a particular point in time. uh, there is another thing which is solvency. Solvency is another critical consideration for stakeholders. Solvency refers to a company ability to meet in financial obligations in the long term by analyzing financial information. So stakeholders can assess whether a company has enough assets to cover its liabilities. It's like checking if a company has enough money in the bank to pay off its debts. Next, finance involves the management, creation, and study of money and investment. It here, yeah. Uh, just give me a second. I'll just share with the. Uh, Yes. Anybody can see my screen now? Yes. So next is, what is finance? Finance is a term for matters regarding the management, creation, the study of money and investments. It involves the use of credit and debit, securities, and investment to finance a current project using future income flows because of the temporal aspect. Finance is closely linked to the time value of money, interest rates, and other topics. So basically, finance involves the management, creation, and study of money and investment. It deals with the how we use credit, debit, securities, and investments to fund current projects using future income. One important aspect of finance is the concept of the time value of money. This means that money available today is worth more than the same amount of money in the future. Uh, Now, question is, why is that? Uh, it is because money can be invested to earn interests over time, allowing it to grow and create more value. Interest rates play a significant role in finance. They determine the cost of borrowing money or the return on investment. Higher interest rates means higher cost for borrowing and potentially higher returns on the investments. Uh, Higher interest rates means higher cost of borrowing and potentially higher return on investment. So understanding rates in decision when making financial decisions. uh, Finance is a broad field that encompasses various topics such as financial planning, investment, management, risk assessment, and more. So it is about making informed choices about how to allocate resources and maximize returns. Uh, Next one is, what is the purpose of finance? Anybody can explain what is the purpose of finance, or any idea? Any Anyone? Okay. Finance involves borrowing and lending, investments, investing, raising capital, and selling and trade securities. The purpose of this pursuits is to allow companies and individuals to fund certain activities or projects today to be repaid in the future based on income streams generated from those activities. So why do we engage in these pursuits? The main objective is to enable companies and individuals to fund certain activities or projects today with the expectations of repayments in the future. This repayment is typically based on the income streams generated from those activities. So now let's break it down further. Borrowing and lending involve obtaining funds from lenders or providing funds to borrowers. This allows individuals or organizations to access capital that may not have on hand, whether it is to start a business, buy a home, or invest in new projects. Same time, investing is another important purpose of finance. When we invest, we allocate out funds into assets or ventures with the expectations of earning a return. Then finance talks about raising capital. Raising capital is a critical aspect of finance for companies when business needs funds to expand develop new products, or undertake strategies, initiatives. They often raise capital by issuing shares or bonds to investors. Then last, selling and trading securities refers to the buying and selling of financial instruments such as stocks and bonds in financial markets. Investors can trade these securities aiming to make a profit based on price fluctuations or market trends. Now, different branches of accounting, financial, there are, as you know that you might heard, there are many branches of accounting, different kind of branches, and they even you heard about different, accounting bodies name as well, like management accounting. When we talk about management accounting, uh, institute comes in our mind is Chartered Institute of Management Accounting. When we talk about financial accounting, uh, we can talk about Institute of Financial Accounting or Chartered Accounting, Association of Certified Chartered Accounting. Uh, so there are different branches of accounting. So like financial accounting, management accounting, cost accounting, tax accounting, and auditing. So accounting is a broad field that covers different areas, each serving a unique purpose. So let's talk, right in and explore these branches. So first one is financial accounting here. So financial accounting, yeah, financial accounting, external reporting. So financial accounting is all about recording, summarizing, and reporting financial transactions of a business. It focuses on providing accurate and reliable financial information to external users such as investors, creditors, and regulators. Then we talk about management accounting. Management accounting is concerned with providing financial information to internal stakeholders, primarily managers, to support decisions making and strategic planning. It also involves analyzing cost, budget, and performance data to help managers make informed choices about resource allocation and achieving the organization's goal. Next one is cost accounting. Cost accounting is a branch that focuses on determining and controlling the costs associated with producing goods or providing services. It involves tracking expenses, analyzing cost behavior, and calculating product cost. Uh, Accountant play a vital role in helping companies understanding their production cost, identify cost saving opportunities, and make pricing decisions. Next is tax accounting, very important topic and very important subject. Tax accounting deals with the preparation and filing of tax returns for individuals and businesses. Tax accountants ensure compliance with tax laws and regulations while minimizing tax liabilities. They help individuals and organizations navigate the complex world of taxes, claim eligible deductions, and fulfill their tax obligations in a lawful manner. Then last one is auditing. Auditing involves examining and evaluating financial records to ensure accuracy, compliances, and reliability. Auditors assess the internal controls and financial statements of an organization to provide an independent and objective opinion on their fairness to accounting standard. Now, also, if you can see that comparison between different branches, what is financial accounting's purposes, audience reporting standards, financial statement, decision making, as we discuss, financial accounting is primarily concerned with external reporting. Its purpose is to provide accurate and reliable financial information to external stakeholders. So, uh, such as investor, creditors, regulators. So the branch follows generally accepted accounting principle, or known as GAAP or international financial reporting standards, to ensure consistency and comparability in financial statements. So management accounting focuses on internal decision making. Its purpose is to provide financial information to internal stakeholders, such as managers and executives, to support strategic planning and day-to-day operations or activities. Same cost accounting is all about determination. Its purpose is to track, allocate, and control cost associated with producing goods or providing services. Cost accountants analyze and reports on the cost of goods manufacturing and may prepare job cost reports. Uh, then accounting is essential for tax compliance. Its purpose is to ensure individuals and businesses fulfill their tax obligations while minimizing tax liabilities. Tax accountants navigate the complex world of tax laws and regulations to prepare accurate tax returns and calculate tax provisions. Last one is auditing. Auditing play a key role in providing independent examination of financial statement. Main purpose is to assess the reliability and integrity of financial information. So auditors, they also follow, generally accepted auditing standards, which is GAAP, to conduct audit and issue audit reports. Next one is recording financial transactions. Recording financial transactions refers to tracking a business finances using various data sources that gauge different financial factors. For example, companies may track each business transactions, including new equipment purchases, product sales, services, costs, and payroll expenses. Recording financial transactions, anybody can see my screen, or can you hear me? Right, if anybody got any issues, just please let me know. Now we will talk about recording financial transactions, which involves documenting and organizing these activities in a systematic manner. This is typically done using accounting software or manual record keeping systems. The goal is to create a clear and accurate record of all the financial transactions that take place within the organizations. So by recording these transactions, companies can keep track of their income, expenses, and other financial aspects. This information is fundamental for understanding the financial health of the business, making informed decisions, and meeting regulatory requirements. For instance, let's say a company purchases new equipment for its operation. This transaction needs to be recorded, including the date of purchase, the cost of the equipment, and any associated expenses. By doing so, the company can accurately track its assets, monitor depreciation, and understand the impact on its overall financial positions. Similarly, when a business sells a product or provide a service, the revenue generated from these activities needs to be recorded. This helps in tracking sales, determining profitability, and assessing the company's performance over time. Recording financial transaction is an essential part of the accounting process. It provides a detailed history of the company's financial activities, which serves as the foundation for preparing financial statements and reports. These records are also invaluable during audits and when complying with legal and regulatory requirements. Any question? Anyone is there? Please let me know if you have any questions or if you can't see my screen or if any issue with voice. Okay, so next one is recording financial transactions. Type of accounting records. Accountants may use multiple record types that track various financial information for business. So these includes accounting records are transaction journal ledgers, trial balance, and financial statements. So recording financial transactions. In the month of May 23, you know that ABC company have had a few important transactions. We'll see how to record them accurately. So if you see here, there are some transactions. ABC company purchased inventory worth $5,000 on credit from XYZ suppliers. On May 5th, ABC company sold a product worth $8,000 to a customers and received cash for the entire amount. On May 10th, ABC company paid $1,000 in cash for utilities expenses. So how we can record these transactions? We will discuss in depth. So we will talk about, that debit, credit, liabilities, and expenses. But now here, how the table look after recording each transactions. So like a descriptions, accounting payable, accounts receivable, cash, inventory, utilities. So first one is, when ABC companies, first May here, when ABC companies purchased inventory worth $5,000 on credit from a supplier. When ABC companies bought the inventory, they didn't pay cash right away. Instead, they received it on credit. So which means that they have to pay XYZ suppliers later. So to record this transaction, we will increase the inventory account by $5,000 and also increase the account payable account by the same amount. So next one is sold products. So here, this time ABC company made a sale and received cash immediately. So we will record the transaction by increasing the cash account by 8,000 and also increasing the revenue account by the same amount. So this reflects the money they earn from selling their products. Next one is 10th of May, paid utility expenses. So ABC company paid their utility bills in cash. To record these transactions, we will decrease the cash account by $1,000 and decrease the expense account for utilities by the same amount. This shows the money going out for the payment of utilities. Presenting financial information. So when we present financial information, we are essentially providing a clear and concise picture of an organization's financial performance. Some key reasons why presenting financial information matters. First one is, as you see, I will quickly explain each of this. Uh, Decision making by presenting financial information in a structured and understandable manner, it helps stakeholders such as managers and investors make informed decisions. Next one is transparency and accountability. Uh, Promote transparency and accountability within organization. It allows stakeholders to see how the company is managing its resources and whether it is meeting its financial obligations. Next one is performance evaluation. Financial information help evaluate the performance of a company over a specific period. It enables comparisons between different periods, identifies trends, and highlights areas that need improvement. Fourth one is compliance with legal and regulatory requirement. Companies are required to comply with various legal and regulatory standards when presenting financial information. So by doing so, they ensures accuracy, consistency, and fairness in reporting, which builds trust and credibility. Next one is investor relations. Financial information plays a vital role in attracting and retaining investors. Potential investors rely on this information to assess the company's financial stability, growth prospects, and potential return on investment. Next is credit worthiness and borrowing. When business needs to borrow funds from banks or other financial institutions, presenting accurate financial information is vital. Lender use the information to evaluate the credit worthiness of the company and determine the terms and conditions of the loan. Next one is benchmarking and industry analysis. Company comparing financial information with the industry benchmarks helps companies evaluate their performance relative to competitors. It provides insight into areas where the company is excelling or lagging, enables them to make necessary adjustments. Regulatory and legal influences, national regulations. There are, national regulations. There are different laws and regulations such as Companies Act 2006, Financial Services and Market Act 2000, Financial Reporting Council Standard and Codes, Prudential Regulatory Authority, Financial Conduct Authority. Just, take a look at some of the key national regulations and their how they works. So Company Act 2006, this act sets out of the legal framework for company formations, governance, and financial reporting in the UK. Financial Services and Marketing Act 2000 regulate financial services and markets in the UK. It established the Financial Conduct Authority and the Prudential Regulation Authority, which oversee different aspects of the financial industry, including accounting standards and financial reporting for specific sectors. Financial Reporting Council, FRC, is responsible for issuing accounting and auditing standards in the UK. Companies audit Investigating and Community Enterprises Act 2004. This act strengthens and regulatory framework for audits, investigators, and community interest companies. Fraud Act 2006. This act defines various types of fraud offenses and provides legal measures to combat fundamental fraudulent activities. Next is money laundering regulation 2017. Regulations are designed to prevent money laundering and terrorist financing. Next one is Proceeds of Crime Act 2002. Uh, this act targets money laundering and confiscation of proceeds from criminal activities. Regulatory and legal influences, international regulations and conventions. There are, international financial reporting standards issued by International Accounting Standard Board, then international standards on auditing issued by International Auditing and Assurance Standard Board, then United Nations Convention Against Corruptions, International Monetary Funds, IMF Code of Good Practices on fiscal transparency. Uh, Next is producing a balance sheet. A balance sheet is a financial statement that provide a snapshot of company's financial position at a specific point in time. Anybody can see my screen? Okay. Please let me know if you can't see or can't hear me. So it represents the company's assets, liabilities, and shareholders' equity. Balance sheet follows a fundamental accounting equation, which is a very, well-known, or you might heard about, asset is equal to liability plus equity, capital, or stakeholders' equity. Producing balance sheet. Balance sheet are essential financial statements that provide valuable information to various stakeholders, including investors, shareholders, creditors, and regulatory authorities. So why are balance sheet so important? Uh, First, balance sheet are essential for financial reporting. They are vital part of a company financial statement, helps stakeholders understand the company's financial position and performance. Secondly, balance sheet provide a summary of a company assets, liabilities, and equity. This information helps evaluate the value of what the company owns, like its assets, and what is owes its liability. Uh, Third one is balance sheet allow for the analysis of a company financial performance over time. Also, balance sheets serve as the basis for calculating various financial ratios. These ratios help assess the company's liquidity, profitability, and overall financial health. Also, balance sheet ensure compliance with accounting standards and regulations. Uh, in many jurisdictions, it is a legal requirement for companies to prepare and present balance sheets, because this helps maintain transparency, accountability, and consistency in financial reporting. Here is a example of always there are two sides of balance sheet: assets and liabilities, and stakeholders equity. So left side, we have the asset sections, which list all the things company owns. It includes items like cash, accounting, receivables, all assets, money owned by customers, inventory, and fixed assets such as building or machinery. Same time, on the right side, we have the liabilities and stakeholders equity or capital. Uh, Section liabilities includes item like accounts payable, money owed by suppliers, company's liabilities like loans and other debts. Shareholders equity represent the owner's investment in the company and any retained earning of profit that have been reinvested. Producing income statement. uh, Income statement, also known as a profit and loss statement or statement of earning. This is a financial statement that summarizes a company's revenue, expenses, and net income over a specific period of time. It provides a snapshot of the company's financial performance and profitability. So it helps and it helps us understand how well the company is doing in terms of generating revenue and managing its expenses. By looking at the income statement, we can see if the company is making more money than it is spending, which is a good sign. Producing income statement. Why producing income statement is important? Income statement helps evaluates company performance. Income statement plays a central role in decision making, like when companies consider a new projects, expansion plans, or investment opportunities. They need to assess the financial feasibility by analyzing the income statement. Uh, Income statements also plays a vital role for maintaining investor confidence when potential investors are considering putting their money into a company. They look at the income statement. And last one is, producing accurate and reliable income statement is essential for compliance with the legal and regulatory requirement. Accounting regulations and standards mandate that companies prepare income statements or part of their financial reporting. It ensures transparency and accountability in financial reporting, which is fundamental for the overall trust and credibility of the company. Any questions so far? Here is the simplified example of an income. Here we have the revenue. These are the amount of money earns from selling its products or services. It includes like things like sale, revenue, fees, or any other income generated by the company's main operations. So then we have expenses here. These are the cost of the company incurs in order to run its business. They can include things like employees, salaries, rent, utilities, raw materials, and other costs related to producing and selling the products or services. So we calculate the net income, we subtract the total expenses from the total revenue. So if the revenues are higher than the expenses, then the company has made a profit. But if the expenses are higher than the revenues, then the company has incurred a loss. Producing owner equity statements. This statement shows the changes in company's owner equity over a specific period of time. It helps us understand what factors have affected the owner's equity, such as the company's profit, investments made by the owners, dividend paid out, and other types of income. The owner equity statement is important because it gives us insight into how a company value has changed over time. It helps the owners, stakeholders, shareholders, and other stakeholders understand the financial health and performance of the business. Any questions so far? Okay, next one is producing owner's equity statement is important for several reasons. Equity statement provide transparency. They help us understand how the company's equity or ownership has changed over time. Secondly, these statements assist in analyzing the company's performance. By examining the owner's equity statement, we can evaluate the company's financial performance and how it has impacted the owner's equity. Next, it plays a role in decision making. They provide valuable information to owners and management. For example, when considering activities like issuing a new share, distribution dividends, or retaining earnings, these statements show us how these actions can affect the company's equity position. This helps owners and management make informed decisions about such activities. And then compliance. Equity statement ensure compliance with the accounting standards and regulations by following these standards. Companies promote transparency and accountability in their financial reporting. It ensures that the information provided in the statement is reliable and consistent, which is essential for maintaining trust uh, among stakeholders. Here is, owner's equity statements, simplified example of an owner's equity statement. Uh, Net income, one of the main factors that affect owner's equity, uh, is the company's net income. Net income is simply the total revenue the company's earned minus all its expenses, as we discussed above. So when company make a profit, it adds to the owner's equity. On the other hand, if the company incurred a loss, it decreases the owner's equity. Another way the owner's equity can change is through additional investment made by the owners. Dividend or the profit that a company distributes to its owners, uh, or stakeholders or sorry, shareholders. When a company pays out dividend, it reduces the owner's equity because the profit are no longer retained in the business. But this is an important point that not all companies pay a dividend. So other comprehensive income here, owner's equity statement may include other comprehensive income. This refers to gains or losses that are not part of the company regular operations. For example, changes in the value of investments or fluctuations in foreign currency exchange rates can impact the owner's equity. So here some references are, and that's all for today. If you have any question, please drop me an email at yasir at ukversity.co.uk. That's it for now. See you next week. Have a good day. Bye for now.